I had this vision because I came up from the bottom. I held every job you could hold on an org chart. And I recognized that.
Welcome everybody to an extremely important episode of Entrepreneurship Exposed, where we talk about everything.
Who are you talking to?
Listen, this is the most important episode that my entire audience can listen to. And I believe so strongly because of what you've been able to accomplish, Kurt. Well, hold on. Let me not get there yet. Hold on. This is an extremely important episode, everybody. And on Entrepreneurship Exposed, we speak about everything related to entrepreneurship with a twist of business acquisitions. But today, let's reverse that. Let's talk about everything about business acquisitions with a twist of entrepreneurship with our guest today, who has done over 58 acquisitions under his belt and facilitating billions in exits. None other than Adam Coffey himself. Welcome, sir. How are you?
I'm doing great. I am glad to be here. And, let's have some fun. Let's get the energy up and going, and let's go down some alleyways less traveled.
Let's do it. So, Adam, I have to say, maybe it is about our industry being in mergers and acquisitions. You at a way higher clip than me, but being in our industry, I think we just naturally have this great energy, right? Because every time, look, as soon as we came on, you're as excited as I am. So I love that.
This is what I do, and I'm not talking about the podcast, but I mean, you're in my wheelhouse now. Yes. We're talking about stuff that I love to talk about.
Oh, let's go. Okay, well, I'm excited about this, but the first thing I have to start with is thank you for your service. I've looked into your background, of course, and know about your military background, and I know you've attributed that to your discipline and your leadership skills overall. Is there anything else you could tell us a little bit about that?
I started so low in life, as literally after high school, private E1 in the U.S. Army. I looked up and I'm looking at bubble gum on the bottom of somebody else's boot. That's how low I am, and for me, it was, boy, what a foundation, teamwork, leadership, discipline. In today's business world, we call it servant leadership. But back in the day, it's like, the military has been cranking out servant leaders for a couple hundred years, in the U.S., and we just didn't put a title on it until recently. But, take the hill, follow me, take care of your people. And so I attribute a lot of my core, principles of being a servant leader to my early days in the military. And so Sergeant Coffey learned a hell of a lot about leadership long time ago. How long ago Ronald Reagan was president. So that's how long ago we're talking here.
That's when you were in the military. Okay.
Yeah. And from my perspective, I mean, like, that really was the foundation, of the rest of my professional career, built upon that foundation of servant leadership, and caring about people, taking care of people, and working with people, and I credit the military for that for sure.
It's interesting because as I've read more about you, and we're going to talk about your books in a second too, but as I've read more about you, I see that as a recurring theme, your belief in the servant leadership. I didn't even utilize that title, but just I saw that you're interested in how companies treat their employees, how they treat their customers. There was something that you mentioned, I think it was in one of your books. It was one of the keys to success is service isn't tangible, right? And it's not a product that could be put on a shelf. I really love that because I think that's extremely important in a time like now where one of the greatest wealth transfers in history is occurring with baby boomers retiring and not having any succession plans. So now we're able to go in and take over these companies, but with that mindset of focus on the employees, focus on the customers.
I got to tell you too. I got to tell you that today, I think this has become commonplace. I think, it's so hard to get employees and to get people to stay and get people who want to work that you have to treat people in this fashion in order to attract talent and keep talent. But I got to tell you, when I was first a CEO.
Okay, before you get to the episode, I just wanted to take another moment to say thank you to each and every one of you for supporting the channel. Entrepreneurship Exposed is starting to grow like crazy, and it's all thanks to you guys. Now, if you like the content, like the information that you're getting, like the guest speakers, like all of the strategies, then the way that you can support us is by subscribing to the channel below. Now, after you subscribe, you want to make sure that you also like every video. You comment on it if you can. And even more important is to click that notification bell. That notification bell will make sure that you get to see every single episode with all of this amazing information so that you can get started on your journey as an entrepreneur. All right, now back to the episode. Let's go.
Which now we're going back decades ago, and if you take, I was a CEO for 21 years. It's been a couple of years now. It's like 23 years ago. How I treated people, that wasn't mainstream back then. And I had this vision because I came up from the bottom. I held every job you could hold on an org chart. And I recognized that culture and revenue are correlated. And I can build a fantastic culture that people love to come to work in the morning, where I take care of them and they get engaged. They take care of customers. Customers give us more work, and revenue rains from the skies. And I learned long before it was popular that if I took care of people, built a strong culture, revenue would happen. And so instead of managing revenue from the top down, I manage culture from the ground up, and I would be rewarded with a strong growth company. And I think it's mainstream today. It wasn't 23 years ago for sure. It was not mainstream at all. So I was preaching the gospel that culture and revenue were correlated, and they were not. Profit and culture were not mutually exclusive. You could do both.
Definitely. I was doing a recent acquisition of a RV dealership, and when you walk into the main office, it was decorated in a way that was almost like a campground or something along those lines. And they said, "Oh, well, you could change all of this, when you're ready." I said, "Why would I do that?"
Yeah.
I love this family feel. Yes, I am going to bring the corporate structure, not red tape, but corporate resources to the business. But the family feel is what's going to help to grow the business. Most customers prefer that instead of going into the super corporate environment where they're treated as a number.
Yeah.
So I agree with you 100%. I love that. But let's go back to your books now, right?
All right.
So I was just having a conversation backstage with Adam, and I was telling him about the BBI, Business Builders Institute, and the 2 curriculums in there. Now, Adam's new book is coming out soon. And when I saw the name, I was like, yes, let's go. Empire Builder, baby. Let's go. That's perfect. I love that, because when we're talking about mergers and acquisitions, we are able to build empires. So that's extremely a perfect title. But let's go back to the first books. And I think this was your first book. The Exit Strategy Playbook.
Private Equity Playbook was number 1. That's up there. Yeah.
Okay.
That side. Yeah.
So I haven't read the Exit Strategy Playbook yet. I have it, but I haven't read that one yet. But Private Equity Playbook, that was, oh man, I love that book, because I didn't understand the world of private equity as much. So what made you, feel that you needed to write that book specifically about that topic?
I have a few stories here about that, to be honest with you. It started with just a desire. Every time we hear about private equity in the news, it's negative. It's just negative. Some private equity guys came in, they buy this company, they destroyed it, jobs are ended. And I'm like, that's not the private equity that I've been working with for the last, few decades. My companies grow. We hire people. We have, I get into a business and I'm using private equity's capital to supercharge growth. And a growth company is a fun company to be at. It creates a lot of opportunity for promotions and advancements for employees. And so for me, it's kind of like the private equity that I am experiencing as a CEO is not jiving with what I'm hearing on TV. Yeah. And so it started getting me thinking about, it's like, I really need to educate the business world about private equity, because here's a fact. Literally, I've been given the same 10-question basic quiz, multiple choice on private equity, all 10 answers found in the private equity playbook. And I've been given this same test, for years. And I got to tell you, even if I have a room with 300, 400 executives, Fortune 500 people, really smart entrepreneurs, 90% of the people flunk that basic 10-question quiz. We've all heard the term private equity, but what I keep proving every time I teach a seminar is that very few people actually have a working understanding of what it is and how it works. And I think it's so important in today's entrepreneurial journey, because private equity, with more than $5 trillion in assets under management, has become the world's largest source of non-bank capital. If we need to borrow money and we need debt, we need to borrow capital. But it also buys more than 50% of all companies on the planet. And so there's a 1 in 2 chance, if you sell a company, it's going to be a private equity firm that's your buyer. You better have a basic understanding of what this thing is and how it works. And in the 21 years I was a CEO, back in the beginning, there was about 800 million in assets under management. I'm sorry, 800 billion in assets under management, less than 1 trillion. And there was about 1,600 firms or so that were, in the private equity industry. Today, there's over 6,000 firms. There's over 5 trillion, in capital. There's 1.9 trillion out looking for stuff to buy right now. And if not for private equity's capital, we would not have the market that we enjoy today. If we're an entrepreneur building something, selling something, there'd be a whole lot of owner-operated, just kind of, hey, dude, you retire, I'll come in and run your company. It's because of the private equity capital that multiples have gone up over time, that entrepreneurs can really generate wealth with their businesses, not just, have a lifestyle, or a career. And so I think it's probably the most misunderstood aspect of entrepreneurism that's out there today. And I think in today's world, people better get educated. So that's why I wrote that book, and it's not deep. And sometimes, on the occasional critic will be like, well, this is like, it's a cursory overview. Yeah, you get it. It's let's take a subject that's really broad and let's not go too deep, because every chapter could be a book. But let's get a basic understanding of what it is, how it works, and make sure that everybody understands it. So ultimately, as an entrepreneur, you can learn how to feed it what it needs in order to take from it what you want. And in my world, it's like, hey, I'm generating wealth. I'm generating wealth for me. I'm building an empire. I'm helping create this great culture where people can come and work for their entire careers. I need capital to invest in the business. I need capital for expansion. Expansion is what fuels growth and opportunity for employees. It's like, we need to understand this as entrepreneurs. And too many people still to this day don't have a good working understanding of private equity. And I think that's why that book continues to be a cult classic. And it, sales keep going up, month over month, year after year. It's like that book just keeps on ramping. And so it was a great first book. It's like a one-hit wonder. It's like
it's one of my favorites.
Yeah.
I'm going back to it every now and then. There's another book. I don't know if you're familiar with this one, and sometimes it feels funny when I say it to certain people, but it's called "Why Should White Guys Have All the Fun?" Have you ever heard of that book?
I have not. No. Yeah.
Now, you being a white male, right?
All right.
It's all right, but this is one of my.
I'm an army man.
Yeah, there we go. Exactly, right. Green. So this book is the story of Reginald Lewis, right? He's the first Black billionaire in America, and he did it through leverage buyouts, right? And he was basically the Jackie Robinson of business, right? The first Black man to take it to that level in America. But your book is one. I have another friend. His name is Ace Chapman, and Ace is the one that really pushed me to learn more about the private equity space. He saw what I was doing and he said, I love how you're doing your leveraged buyouts. Once you get to certain levels, you want to use private equity more. And I just prefer the private equity side. I was like, well, I never really understood the private equity side. He gave me a little bit of insight, but your book helped me to really, understand. So I'm going to put myself on the spot a little bit. You want to ask me like one or two of those questions that you say that everybody, they always get it wrong? I don't know.
These 10 questions were really basic type stuff. And so I'll give you
all 10. Don't give me all 10.
I'm going to give you an example of some,
Okay.
So what is the average lifespan of a private equity fund? Is it 1 year, 3 years, 5 years, 10 years, or it's a trick question and it's unlimited?
Wow. So I would say 10, remembering this in your book, I remember something like 10 years, and then there's often an option for a year or two that people forget that they can't liquidate during that time because private equity means no liquidity. And
well, you got it right. You already got it right. It's 10 years. Yes, it's 10 years. Yeah.
No more questions. I'm going to run with that win.
We'll quit right there. Yeah.
Quit while you're ahead. Let's go. All right. So going back into just the concept of private equity and when it is used, right? So as I've been teaching, and executing, I was focusing on those mom and pop businesses that are under 5 million to acquire, that I could come in really easily, a couple quick changes, increase the value, and then exit. This was before I realized the power of AUM, and I was focusing on, hey, let me just keep making some good money from quick exits. Now, I didn't need private equity at that time because how I structured the deal was usually through that leveraged buyout, loans, etc. But then once you reach, I would say, and correct me if I'm wrong, what's your opinion? Maybe 10 million to 100 million is where you should really start looking at private equity firms, maybe 100 million and up, family offices. What would you say?
So I as I talk about in here, Empire Builder is the road to $1 billion. And so I talk about the stages of growth and most entrepreneurs top out somewhere around 30 million, 30 million in revenue. It's like, I run out of bandwidth. I got to find this second gear. I got to learn how to be a conductor of an orchestra rather than the anal retentive first chair control freak player of every part of that orchestra. And it's like a lot of entrepreneurs top out. And the way that I look at private equity is, if I think about EBITDA for a second. So, I talk about in here about this thing I call the private equity pyramid. And there's 5 levels in the private equity pyramid. You take this 5 trillion in assets under management, and you got 6,000 firms with $5 trillion up one side of the pyramid. At the top, you got people like KKR and Blackstone and Carlyle and Apollo, and their funds are 10 to 30 billion in size. And then you got 6,000 firms all up and down this thing, and they all do the same exact thing. They invest 6 to 8% of their fund in any one company. And they can't invest more than about 12% because they've got asset diversification rules within their own fund charters that they don't want to violate. And so as a result of that, a big PE firm and a big fund can't buy small companies. It'd take them 100 years to put all that money to work. And so big firms buy big companies, small firms buy small companies. And since everybody's investing 6 to 8% of their fund in one company, it creates what I call 5 steps to the pyramid. And the real private equity world starts at about 4 million of EBITDA. Below that, you got people who may call themselves a private equity firm, but they're not really raising capital. And if you think about the average leverage buyout before interest rates, shot up as they have in the last couple of years, it was kind of 50% debt, 50% equity. And so if I'm buying if I've got a real fund with limited partners and I'm out raising capital, kind of 4 million in EBITDA is where the smallest real private equity firms that have actual funds with limited partners and they're raising money, that's where it starts. And you've got people who kind of go from 4 to 15, 15 to 50, 50 to 100, 100 to 200 to public. And these firms, because they're all doing the same thing, this 5 trillion in assets is swimming back and forth, and it's really disciplined capital. And so I tell entrepreneurs, when you're building a business, there's two natural exit points to private equity. The first is when you hit around $4 million of EBITDA. And the second place is at about 10 million of EBITDA. So it used to be 15 to 50. But all of the 5 levels have been pushing down a little bit because I got a lot of money, not enough good stuff to buy. And so I'm flexing down a bit, looking for a good company that hasn't quite grown into my space yet. And at every one of these little inflection points, I get rewarded with multiple expansion. So let's talk about rarity in business. In the United States alone, there's 33 million small companies. SBA defines it as 500 employees or less. The bottom 2 layers of the pyramid, there's 33 million companies in those bottom 2 layers. But if you go all the way to the top of the pyramid, there's only 3,000 companies on the planet that have $1 billion in revenue. And 2,000 are public, 1,000 are private. And so small, dime a dozen, 33 million just in this country. Really big, only 3,000 on the planet over $1 billion. And so bigger companies are rare. And as we get bigger, people pay more for them because there's less of them. And so there's a fiercer competition. We're rewarded as entrepreneurs by getting this multiple expansion as we get bigger and we're climbing the pyramid. And so as a buy and build guy, my last empire, I bought 23 companies, put them together. And I bought them all at a 5x multiple when my company's trading at a 14 multiple. And that creates arbitrage. And that arbitrage is how the private equity firm makes its money. And frankly, because I'm making them money, that's how I'm making my money and generating my wealth, is because I'm riding with them. I'm using their checkbook. I'm a tool. And so when I look at an exit for an entrepreneur, I think 4 million EBITDA is my first real exit point where I can get a good firm that I can work with. And if I'm building kind of my kind of companies, which is guys, trucks, broken stuff, guys, trucks, building things, not to sound sexist, but that's kind of my wheelhouse. So it's like, HVAC and commercial laundry and, real sexy industries like that. Dudes and trucks out fixing stuff is my world. And so, as I'm building a company and I'm climbing the pyramid, it's when I get to that first 4 million, I can count on about an 8 multiple ish. You get somewhere between 30 and 40 million for that company. If I sell it for the first time there and I bring in private equity and I take some chips off the table, diversify my asset base, make a rollover investment alongside their coattails, and then I start working with their capital to build to the next exit point, which would be about 10, 12 million of EBITDA. And then a bigger firm comes in, buys from a smaller firm. They take it up to the next level of the pyramid and they take it up to, used to be 50. Now it's about 40. And then they sell it upstream to somebody else. And every time we're doing this, we're rewarded. So I tell people, if you're an entrepreneur, how much money do you want to make? Do you want to be a 9-figure guy? Then you want to get to 10 million of EBITDA before you sell the first time, because that company, dudes, trucks, doing things, that I'm selling for about 8 times when it's got 4 million of EBITDA, I'm probably selling it for 10 to 12 times at 10 million of EBITDA. And so I'm probably looking at about $120 million exit. And if I can learn how to shift entrepreneurial gears, because when I get to 30 to 40 million of revenue, I'm probably at that 4 million of EBITDA mark where I can exit. And I get a good payday. Don't get me wrong. But if I can learn how to shift gears and hire people and become a conductor of the orchestra and focus on process, not every transaction that's happening, and I can kick that gear up and I can get it up to 10. Now I'm looking at a 9-figure exit. And so, but I tell in my book, I don't want entrepreneurs to go any larger than that. There's no reason. I want you to ring the bell. I want you to get asset diversification. I want you to take chips off the table. And I wrote an article for Forbes a while back. I called it the Law of 130. I get asked so many times, when's the right time to sell? And how do I know when it's the right time to sell? And I tell people, take your age as a number, 2-digit number, and then take the percent of your net worth that's tied up in this illiquid thing called your company. And if you add that to your age and it's over 130, chances are you need to do something to de-risk your family. You know, you've got too much risk on the table. You know, if you're, and what it has to do with is, you know, the economy runs in cycles. You know, if you're in your 50s or 60s and 90% of your net worth is tied up in your company, you're at like 140, you're over 130. If a bad cycle comes, when planes fly into buildings, when the Great Recession happens, when a pandemic happens, you can get ruined and not have enough time left in your working career to recover. So I want entrepreneurs to take chips off the table. When you get to that call it no larger than 10 million of EBITDA, I want you to sell to private equity. And too many entrepreneurs look at private equity and they say, when I sell my company, it's a one and done thing. And it's like, if I'm not controlling and I'm not the majority shareholder, I don't want to have anything to do with my company. No. And that's the wrong answer. You know, PE is the world's most sophisticated asset class out there. Ride their coattails. You know, get multiple paydays. My personal record is getting 5 paydays at one company over 13 years and 4 months. It's kind of like you're in Vegas. And you've been on the blackjack table for a while and you made some money. So you put your original money back in your pocket. That's the diversification. And now you're playing with house money. You know, the analogy here is, as I get to these exit points, I'm taking wealth out and I'm diversifying to protect my family and my future. And now I'm playing with house money. Now I'm going to use a private equity checkbook to start doing and accelerating the kind of things that I was doing. You know, the M&A that I was doing at a small scale because money was hard to get when I was a little company. Now I got the biggest checkbook in the world. And really what that means is they've got debt relationships that I can leverage, and I can get outsized amounts of capital that let me accelerate my growth story. Second problem entrepreneurs have as they get older is they get conservative. And I'm not talking politics here. It's you know, I get in my 50s and it's like, boy, I know I've got risk. I'm over the law of 130. Yeah. And so I'm not going to invest in growth anymore. And I'm not going to take risks. And because they haven't diversified their asset base, you know, it's like they're afraid to take risk. And it's natural. And if you take a bite of the apple and get some money out of the business, then roll forward, you know, I'll call it 30 cents on a dollar, you know, of dollar that you make. You know, if I can turn around then and get a 4x multiple of invested capital by working with private equity, my second check's bigger than my first. And my third check will be bigger than my second. And, you know, if you leave a company, I give you a wheelbarrow full of gold. First thing you got to do is figure out what the hell to do with it. Why not keep some invested in this thing called your company that you know all about and keep running it and then running it with a partner? So I just went off on like this 10-minute tangent, but that's, you know, that's the basic gist of it. You know, I think, you know, private equity, you could, as an entrepreneur, I want to get to 4 million and I can ring the bell and I'm going to make 30 to 40 million, you know, on the enterprise value of the asset. If I've got something with legs and I can keep on going, I can stay independent, get to 10 million of EBITDA. Now I'm going to be a 9-figure entrepreneur. Ring that bell, keep going, but now do it with house money. So, you know, what I talk about in here is there is a time where you should partner with private equity rather than try to remain independent. Because if you really want to get somewhere special, you want to build $1 billion business, you're going to need capital and you're going to need partners. And guess what? You're not going to be the sole shareholder anymore.
Exactly.
Jeff Bezos, richest man on the planet. He owns 12%.
Exactly.
He owns 12% of Amazon, people, not 100%.
Yeah, that's one of the most common sayings that I use, right? Is I say that 25% of a watermelon is better than 100% of a grape.
Yeah.
Right? And that's the mindset shift that people need to make. But Adam, this is probably the worst episode of my podcast ever because every word you say makes me want to ask you more questions. So I'm like, my mind is like all over the place right now.
Well, we can just make it a long podcast. You got part A and part B. Yeah.
So tell me this. Oh man. Well, first of all, I had never heard of that equation that you demonstrated earlier on. Is the law of 130, is that the name of the equation? Is this something in the industry?
Well, I figured since it was my rule and I created
it. So it's your
and then I wrote it and it went in Forbes. I figure, okay, so come to Papa. It's like I get to name it. So I called it the law of 130, the rule of 130, because that really is a question I get asked all the time. When's the right time to sell? Take your age, 2-digit number. Hopefully you're not 100, thinking about selling, and you're not 9 either, selling your watermelon stand or your lemonade stand. So it's like you take my 2-digit age, and then I add the percent of net worth tied up in the company. And if it's over 130, and so I did analysis. I didn't just pull it out of the air. I looked at the 58 companies that I bought. I thought about all these entrepreneurs that I gave wheelbarrows full of gold to. And I really put some thought around, asset diversification and, at what age do people start changing their habits and start running from a more conservative bent, and they're losing opportunities to grow. And that just felt right. It came. I ran that math many different ways. And so I coined it the rule of 130 and then had Forbes put it out there. So that way it's now, it's in the public domain. It's no longer, my law. It's now the world's law. And
I love it. So tell me this now. Well, first of all, two of the exit points that you mentioned is perfect, because once you get to that 10 million in EBITDA, the multiple is going to increase, not exponentially, but a significant amount.
Yeah.
So I've seen. I'm going to run through something really quick with you, because I'm just loving it. This is a quick summary of an acquisition that I was just recently doing, right? Core business, 5 million. Top line revenue, 20 million. I'm going to say SDE instead of EBITDA, because they did have add backs. So, owner operated. Their SDE was about 2 million. So 10% profit margin and increasing. All right. Now, the industry multiple, like when you check like Equidam, was around 12.09. But because it's under 10 million EBITDA, you rule of thumb, you divide by 4 and got about 3.02 for the multiple. So we actually got it at a discount, because it should be worth, just a little bit more. However, our scaling strategy is through acquisitions and efficiency. So we're doing a roll up.
Yep.
Right. So we're going to, add additional businesses underneath this umbrella. And the second business, first before that, goal number 1 was to scale to 50 million top line revenue within 5 years. Right.
Yep.
But the second business that we're acquiring underneath the roll up comes with 40 million top line revenue. So we're already going to beat the 50 million top line in 5 years. We're going to beat it by probably 4 years. It'll take us 6 months to get the other business as well. Goal 2 is to scale to 100 million top line revenue. Why? Because I told you that it was 10% profit margin. And even if we don't do anything to increase it through efficiency, 100 million, 10 million would be the approximate EBITDA at that time, because 10% profit margin. Yeah. And now it goes back to that 12.09 multiple, $120 million company.
That's what I just said, right?
Exactly what Adam just described.
Yeah. So for our listeners who want this broken down really small and simple numbers, let me give it to you this way. If I buy 4 companies and each one has $1 million of EBITDA, let's assume that this industry, those companies trade for 5 times. So I buy 4 million of EBITDA, 4 companies, 1 million each, times 5, I'm going to spend $20 million. If I put those 4 companies together, that $4 million EBITDA company is worth more than 4 $1 million EBITDA companies individually. So as long as I've integrated it, I've demonstrated some growth, and I've really created a company, not just a collection of companies, then I can sell that 4 million of EBITDA in this given industry for about 8 times. And at 8 times, I've now got 32 million. So it cost me 20 million. If I had all cash, unlimited cash, don't worry about cash yet, but I buy 4 companies, $1 million EBITDA each. I pay 5 times, it's $20 million. I put them together, I integrate them, and I sell it. And then I sell the same 4 million now, but it's one company. I sell it for 8 times, it's 32 million. I have a $12 million profit. And I could do that all day long, like in a year, and put these things together and do that. But if I wait a little bit and I get them now, I create some operating leverage, I focus on organic growth, maybe some cross-selling, and I get it to 5 million of EBITDA. Now I'm selling it for 8 times 5, 40. Cost me 20, I get 40. And I'm maybe instead of a year, I took 2 years to do that. And I just made $20 million, right? And so, and if I buy 10 companies with $1 million EBITDA each, and I pay 5 times for each of those, I'm going to pay 50 million for those 10 companies with $1 million, EBITDA each, or I'm sorry, so I buy 10 million times 5, 50, right? Now I put those together at year 12.09, and now I sell it for 120 million. I just made 70 million. And so this is what we're trying to accomplish when we're entrepreneurs. It's not about necessarily building, this company from scratch and I need a seed of this. And, it's like, hey, God bless you. But VC funds don't usually return very well. Buyout, baby. That's where the action is, and so like what you're doing, if you do this and get good at this, it's like I buy 4 companies, I put them together, I make 12 million. I buy 10 companies, I put them together, I'm going to make, a whole lot more. I'm going to make 70 million. And so, this is how you can really create and generate a whole lot of wealth in a short period of time. I've got half a dozen of these going on right now.
Roll-ups?
Yeah, that I'm doing just like this. It's like, I don't need to build, I'll never forget this. When I was at GE, back in the Jack Welch era, I used to be so proud of seeing my meatball, on that business card. And it's like, man, I'm a badass. I got this GE meatball on that card. I'm something special. Yeah. Quickly, you learn, you want to make money. Don't care about what is on the business card. You can spend your whole life, working at that meatball, and you're not going to make anywhere near what I just talked about that you could do in a year by buying 4 small companies and putting them together. And so, I mean, that's the knowledge, that I'm trying to convey in my books. And I'm going to show you this picture because I got this chart in my book.
Oh, the pyramid.
Yeah, so here's the pyramid, and you'll see that the multiple inflections, at the different sizes, the multiples go up. Typical multiple paid goes up, and it's like, here's the 5 swim lanes of the PE pyramid. And it's like this private equity, why do you think it's gone from 800 million in assets under management to 5 trillion in the 21 years that I was a CEO? Well, it's not because they suck. It's because they're pretty good at putting all that money to work and making money for their investors, for their limited partners. And so, what I teach entrepreneurs today is how to do this on a small scale. I was doing it on the orchestra stage, baby. It's like, 34 companies, put them together, 3 different sets of shareholders, and 23 companies with 2 sets of shareholders. Hey, you don't have to do 34 or 23. You could do 4,
5. Yeah, 4 or 5. Yeah.
And you're going to make more money than all them Fortune 500, employees who are proud of that, that logo on that business card. And,
So I've done, so for my own deals, I've done over 22 different deals, including with, for clients, partners and such, I've done over 40. Now, I've only just recently started the roll-up strategy because I was like you. I like the, how did you phrase it? Boring, guys in trucks fixing broken stuff. So
trucks, broken stuff.
These trucks, broken stuff. Yes. So same thing. It was, pest control company.
Oh, beautiful one. 30% EBITDA margin right there, baby. Which means I buy a $3 million company and I get $1 million of EBITDA. And it's like, at 10 million of revenue, I'm getting ready for an exit.
Yes, exactly. So those were great. But now I'm getting into the roll-ups more. We're doing roll-ups in infrastructure construction, recreational vehicles, logistics. Yeah, those are the 3 major roll-ups that I'm doing right now. But you said something that I've been hearing a lot because now I'm speaking to more private equity firms. And they say, we just can't find enough deals. And I'm like, what? I'm overloaded with deals. I'm a kid in a candy shop, and I'm talking about great deals that come obviously all of them are cash flow positive. I don't do distressed businesses. All of them have a lot of assets in it that could be collateralized.
You're
All
playing in a world where they can't. So remember I told you that PE pyramid has a false floor at the bottom. Real PE firms that raise institutional capital started about 4 million of EBITDA is like kind of the lowest size company they'll buy. And so you're playing below their radar screen. If you're doing these small companies and putting them together, what you're doing is at the bottom of the pyramid in the false floor, you're serving up a meal. Here you go, boys. Here's your $4 million EBITDA meal. And again, it goes back to, remember, I put 6 to 8% of my capital in my fund to work buying one company. And I can't put more than about 12, or I'm not going to have the diversification that I told my limited partners I would maintain. And I've only got 10 years, which means I can't go too small, depending on my size fund, because I can't put all the money to work. And so you are operating in their gray area where they really can't play. And the other people who are joining you down there, if they are a private equity firm, they're not a traditional private equity firm. It's probably a wealthy dude, who's got a bunch of capital and started his own PE firm. He let his buddies in, his friends, and it's like, and they call it a private equity firm, but they're not actually raising funds from real limited partners. And so you're playing in that bottom of that pyramid below the floor where there's a false floor, and you can make hay all day long, in that area. And as you get something that's got legs. And so what I tell people too is, look, start with the goal in mind. I want to hit the $4 million mark, and then I'll decide whether I stick with it. I'm liking it, and it's an easy putt. Let's go to 10. And if I don't like it, then it's like, okay, I get to 4 and I'll move it on down the road. I'll put my 12 million in the bank, and then I'll go back and do another one. I do want to talk about one thing you mentioned, because you talked about pest control. And then you talked about construction. So I talk about in here a couple of different things. One is invest in what you know. And secondly is invest in what people needs versus wants. Our economy has this thing called a cycle. And lately our economy is doing all kinds of weird crap, and cycles are coming faster. And when I think about, like you talked about that pest control, what makes pest control so great? Services type businesses have very low capital expenditure requirements. So I need a dude needs a truck, because I said, dude, trucks doing right. And so pest control, I got a truck with a dude, who's out spraying, bugs. However, I don't need like a plant. I don't need all this manufacturing. There's very low capital overhead. And at the same time, there's a recurrent revenue stream, and Wall Street rewards recurrent revenue streams. Not only is it recurrent, it's contracted recurrent, because my homeowners, in Florida got cockroaches the size of alligators. You can put a saddle on it. If you move to a state and there's a bug net over your backyard, tell you that you need pest control right there. That's a good hit. And so you sign a contract. And because you sign a contract, at the first of every month, I bill you. And pest control companies, they come and spray once a quarter, but they bill you every month. And so
MRR.
And it's recurrent revenue. Construction, a dirty word on Wall Street. They call it installation, because that's sexy. But construction can be cyclical. So if an economy turns south, then people can defer projects or delay projects, and as a result, generally speaking, construction firms aren't rewarded with as high a multiple as, call it like that pest control, recurrent service, recurrent revenue. You can still make money, and don't get me wrong, but you can also get caught in changing market conditions, and you could potentially get hurt. So there's some risk involved. And so I teach people in here how to think about, different types of industries. And then I've got a lot of friends that I work with who are real estate investors. Boy, talk about needing capital. If you're a real estate investor, and you want to create $1.5 million in free cash flow, I bet you got to leverage a $60 to $80 million portfolio of real estate in order to do that. if I build a service company on about 1.5 million of capital expenditure, I can generate about 1.5 million in free cash flow. And the ratio is kind of 1-to-1. So for you people who are out there and like, you want to make a quick 12 million, you want to make a quick, 70 million, do what you're doing, Beez, and just little companies, buy good ones. I love that you said that, by the way. I love that you said that. Empire builders do not buy fixer-uppers.
Thank you.
Leave distressed assets to somebody else that wants to screw with them. And I'll give you just kind of one, so I talked about a company where I bought 23 and put them together. Well, company number one was a problem. And it was less than 5% of my revenue. And it was 80% of my headaches for about 3 years. Do not buy, fixer-uppers. Life is too short. Buy good companies with good reputation, with good people, good, strong culture. And like you said, with all these this transfer of wealth and all these retiring baby boomers, here's another scary statistic. 80% of all companies never find a buyer. They just turn off the lights and, I'm retiring, I'm hanging up my shingle and it's like, I'm done. It's like, and nobody bought it. I didn't, it's like, so.
And in particular now, because most baby boomers wanted to leave it to their kids, but their kids want to be TikTok stars and stuff like that. So they don't want the business. So this is a perfect time for people like us to come in and it's a win-win on both sides.
It is.
Let's jump into that. Okay, right before I jump into that, because I did see a video with you and JT Fox, and I want to talk about that video in a second. But before we jump into that, when it comes to leverage buyouts, I guess we will go right into the thing with JT Fox. No, I'm sorry. Before that, I got to challenge you on one thing that you said.
Okay.
You said, and I do agree with you to an extent. And Warren Buffett says this all the time. He only invests in businesses that he knows, right? Industries that he knows. But I'm gonna challenge you on that a little bit because that was my perspective for a while. But then I realized my superpower is building the right teams. Yep. I don't have to know everything about that industry. I know how the general tenets of any business work. Process, systems, people, for example.
Yeah.
However, I'm going to bring in the right people who know that industry well.
So let me clarify that a little bit. All right. So every company that I ran as a CEO, I never had any experience in until somebody hired me as CEO. Yeah. And so what my generic superpower was, I can create a vision, I can articulate a vision, and I can move people to want to achieve, that vision, and I can motivate people. And when I laughingly talk about dudes, trucks, broken stuff, that fits 50-50. I made my skills generic, just like you did. And so my skills are, you give me a company that's got dudes, trucks, and broken stuff, or dudes, trucks, building things. That's my wheelhouse. I don't care what industry it is. I don't need to have industry experience, but it's what I know. Yes. What you know is how to get the right people together. And to you, the superpower is I can assemble the team. I can make the leverage buyout happen. And I'll rely on this team of people that I put in place to understand, to learn the industry. And I learn every industry I'm in, eventually, but it's not germane to me being successful. And so what I'm trying to do when I'm saying stuff like that is I'm trying to teach a generation of future entrepreneurs how not to get in trouble. So you and I have learned how to take a skill set and we can apply it very broadly. But if I'm just getting out of business school and I don't have this superpower yet, it's like I talk about investing in what you know because I don't want people to get hurt. It's like with real estate investing. Invest near your home. Let's start with if you're going to do multifamily housing or single family housing, start in the city where you live, where you know good neighborhoods and bad neighborhoods and what's a good area that people are going to want to be in, as a renter, et cetera. It's like, somewhere, if you're getting started, you got to have some strength. And my strength, is generically applied now is just, it's services type companies, it's construction, it's installation, it's engineering. It's like, it's these not sexy, kinds of companies that, dudes, trucks, broken stuff. you've learned what, you're mature in this. You're not a newbie. You're not just starting out, and so
I still consider myself a newbie when I'm talking to people, speaking with people like you, but yeah.
My books are designed to try to educate and give best practices to people who are just starting out on the journey. And so, it sure is helpful. And I also call it position, or pivoting from a position of strength. So let's say I'm in the Fortune 500 world, and I'm working in, so me, I'm at GE, I'm in GE Healthcare. I'm working in healthcare services. If I'm going to pivot and do something entrepreneurial, I don't want to go open a bakery. I don't know a damn thing about a bakery. Pivot from a position of strength, and let's take this knowledge that I've built up in medical services, and let's go do something in medical services for my first entrepreneurial, jaunt, because it's at least it can leverage my experience that I've built up. And so I want people at least to start their journey to try to pivot from a position of strength, and get into something that's familiar where they can dig in and be successful. And as you get experience, you get older and you've done this a few times, okay, you broadly define what you can play in. But if you're starting out for the first time, I prefer you start where you know something.
Well said. Okay, I take back my challenge then. So let's get into this conversation about this video with you and JT Fox.
Yeah.
I'm all brokers, all sellers. Make sure you watch this video. I've had in deals where everything is going great, build great rapport with the seller. Even the brokers love me. Wow, this is the best experience I've ever had in selling a business. Then the broker or the lawyer of the seller research me a little bit more. They see like my TED Talks, and on my TED Talks, I'm talking about mindset.
Yeah.
And in mindset, I'm saying, don't think you don't have money to acquire a business. There's ways that you can acquire a business through things like leverage buyouts, where you're stacking the deal and incurring debt in the business in order to pay for the acquisition. Yep. You don't have to have money out of your own pocket all the time to go into an acquisition. But that could just mean the SBA 7A loan. That's not my money, right. But that's the concept of no money out of your pocket is something that I promote as well. But I've had sellers and brokers, they see that and they're like, oh, this guy's trying to get over me. Yeah. What do you mean? No, I'm not. Yeah. Then I saw the video with you and JT Fox, and JT was like, hey, I'm a millionaire. I got into millionaire real estate. Here's a billionaire. If you want to be a billionaire, go into business acquisitions.
Yeah. So I use this statistic, and I'm kind of throwing fun, because JT does come out of the real estate world, and I love my real estate friends and investors and my clients, but I kind of say, okay, so there's 2,668 billionaires on the planet today. Mm-hmm. And there's about 735 in the US. 193 became billionaires by investing in real estate. Mm-hmm. That's 7%. Mm-hmm. 93% of billionaires did it with business.
Business acquisition.
Like, I teach people how the 93% get it done. Drop the mic.
Drop the mic. I love Adam, man. This is awesome.
And that's not picking fun. I'm just saying, boy, you're working. Here's what happens. People usually are successful, and with their success comes extra income. It comes investable income, and a lot of them turn to real estate investing. But it was actually business or their professional world that was creating their wealth. And as they made their pivot, they were taking their excess capital and money and starting to invest in real estate. And I'm telling some of them, look, it's a rough market out there. There's a lot of opportunities for those who are sophisticated, those who know how to deal with it. But if you're just starting out today and you haven't done either, pivot back over here, because for a lot less capital, you can build an empire and you can generate a lot of massive wealth. And that's how 93% of billionaires on the planet were made, was by investing in in businesses. And
on top of that, especially now, real estate may appreciate, I don't even want to say 30% in 10 years anymore.
Here's what I know. I know what I'm good at, and I know what I'm not good at. And I think that's a tough lesson for all entrepreneurs to learn. So I'm the goose that lays the golden egg. I know how to make money in business. And I'll just tell you right here in front of God and the whole world, I suck at investing. But I know how to make money in business. And so I do what I do best. And so I manage my portfolio of business investments, all my private equity investments, all my private company investments. I handle all that because I'm an expert. Yeah. But with everything that I'm taking out is my diversification. I throw it over my shoulder and I let my wealth management team catch it and let them do their thing, because I don't want to even mess around over there. It's like, the stock market's down at 1,000 points. I don't even give a damn. It's like, that's their problem.
Let them handle that. I agree.
They're handling that. I got this. This is my wheelhouse. This is my area of expertise. So recognize where you have strengths and when you have weaknesses, rely on other people who are experts to help you.
Exactly.
I'm also seeing a lot more of this, in today's world, in my world starting out, people weren't so hot about having coaches and peer groups and leveraging the knowledge of others. Today's world, boy, that's just everybody, is working with others, building peer groups. And, the more you can recognize your weaknesses and then shore them up with other people who are experts in your weakness, the better your journey becomes.
I was watching an interview with Robert Smith, and he mentioned, for example, that especially when it comes to mergers and acquisitions, this is an apprenticeship game. Yeah. This is not something, we live in an age of YouTube University and Google Scholars, but this is not one that you don't know what questions to ask Google in order to get to understand how to work in the M&A.
That reminds me of something. It's like, here's a story I could tell you. I bought 58 companies, and so let's say 50 of them. That way, all 58 people can't come back and be mad at me, so they don't know which 8 I'm talking about. But I'll say 50 out of 58. At some point when you're courting, a business owner and you're making an offer, you're going to buy the company. At some point, there's always kind of that opportunity for them to ask questions of you. Mm-hmm. And I cannot tell you how many times I could hear just crickets. It's like they don't know what to ask. They don't know. And so that's why I wrote the exit strategy playbook, the one up down that side. And it was like, I want to educate people about exits. And how to maximize the potential of a business and how to build a team of experts to help you level the playing field. Because, look, if I bought 58 companies, if you're selling one for the first time, you and this is I call it the arrogance of success. And that was my Forbes article last month. It's the arrogance of success. Entrepreneur builds a successful company. God bless them. Only 7% of businesses get to $1 million in revenue, and only 4% of those get to 10 million in revenue. And, of those 58 companies, everything I bought was kind of between 10 and 30. I had a few that were like 125, but most of them were like kind of $20-30 million, buy 30 of them, put them together, buy 20 of them, put them together. And those entrepreneurs, they've achieved a level of success that very few people on the planet ever achieve. And so they should be very proud of that accomplishment. But unfortunately, it comes with it an arrogance of success where they think, I know everything about everything. And boy, and so I go into an exit. I don't need a team. Billy Bob's been my lawyer. So we played high school football together. It's like we golf every Sunday. And, when an employee sues me, it's like he takes care of it. And, I think once upon a time he helped sell a company somewhere. And, it's like, and I'm good with him. And it's like, boy, this is a world of sharks. And I'll tell you, when you have a lawyer on both sides of the table and they've passed the bar, well, it's fair game then, so I've seen lawyers ship out a document and then I'm going to change these 5 words in the indemnification paragraph. And I'm just going to see if they catch it in the first draft, because any competent business attorney is going to catch these 5 things and they're going to turn it back. And they're going to probably not only change those 5 words, but probably just give me a comment like, nice try, asshole. But I know what I'm doing here. Yeah. And then you get back a red line and it's like, those 5 things weren't touched. Yeah. And Billy Bob is focused on a bunch of stuff that means nothing. And you're like, okay, I got me one on the rod. Yeah. It's like, I'm a fair guy. And I always want because I don't want to spend too much on legal fees going back and forth. I always tell my attorneys, I'm going to assume that there's competent counsel on both sides of the table. Let's start with reasonable and customary for this industry for a given size. And let's take a deal off the shelf that's already been closed and fully negotiated. Let's start there. This company looks like this one. I'll use this as a template. And I want to get to the chase quick. And if you start with if I try to game and then I got a good lawyer over there, it's like, we're going to go back and forth a whole lot more. Let's just start here. And I want to get a deal done, and I want to get it done fast, because I don't need to game anybody. If I just let arbitrage, if I'm buying good companies from good people, and if I'm doing rollover investing and I'm letting them ride along, they're going to be my partner when the deal's closed. Let's just do fair, reasonable customer, because I'm going to make my money by climbing the PE pyramid, and I don't need to game anything. I buy good companies, I put them together, I climb the pyramid, I sell them for a higher multiple than the multiple I'm buying at. My money's guaranteed. I'm going to make my returns. And so life's too short. I don't need to screw people to make $1. I can treat them well, and we can both make $1.
Exactly. So I need that hot take from you though, Adam. So what are your thoughts overall on leverage buyouts and the ability to, quote unquote, get a business with no money out of your pocket?
I love that approach. Matter of fact, that's my goal in any transaction I'm going to do from here on out. It's like, why use your money when you can use somebody else's money? OPM, baby.
OPM, other people's money.
Is the best kind of money to use, and I'll leave mine in the bank.
Let's go.
My wealth management team, let them manage that. So OPM is always good. So here's kind of my golden rule and my how I think about it though. Yeah. I want to buy a business that, so I have this thing I call the 30-20-10 rule. Another rule. I don't know if I've written an article about it yet. I will if I haven't. So when I analyze any business, I'm looking at their financial statement. I'm looking at, I want at least 30% gross profit. SG&A needs to be 20% or less, and I need net profit to be 10% or more. Those are kind of my goals. So recently looked at a company that had literally, it was like 38% gross profit margin, 12% SG&A. And so huge profit margin at the bottom. And so, in a services business with little CapEx, little capital expenditure, free cash flow and EBITDA are pretty close. Yeah. And sometimes when I'm in an asset heavy, like a construction business you mentioned, maybe I got to buy a bunch of equipment. So my cash flow, half of that gets used to buy equipment every year. And so I got to be careful about that. But if I can get a service business that's got good free cash flow, my rule of thumb is I want to use half of the free cash flow or less to service the debt. So let's say I buy a $3 million revenue company with $1 million EBITDA. I was looking at one yesterday, and those are good math, good numbers. And I'm going to pay 4 times for it. It's $4 million. Okay. If I leverage 100% of the 4 million at a 10% interest rate, and it's a slow or low amortizing loan where I'm not even paying principal. I'm just, I'm just paying interest. It only takes $400,000 a year in free cash flow to service the debt on that company. And I've got $1 million of free cash flow. Mm-hmm. So I want, I want a cushion. So I look at leverage buyout as I want to use the cash flow of the company to service the debt on the company while I'm looking for other companies to put with it. Yes. And I want to kind of keep it below about 50% of my free cash flow servicing debt. So maybe I'm taking some distributions along the way, and or potentially I'm also accelerating my debt pay down, along the way if I have a good year, and maybe I did $1.5 million, and so I want to use the cash flow of the business. That's why it needs to be a good business. Yes. I don't want to buy a dog with fleas. I want to buy a good company with good cash flow, and that cash flow is going to service the debt that's required for me to buy it. And if I can buy a few of those and put them together in that fashion, I can climb the pyramid. And then when I pay off the debt, when I'm ready to go. So if I do that 4 times and I get to 4 million of EBITDA and I sell it for 8 times, I got 20 million in debt, $32 million sale, pay off the debt, put 12 million in the bank, and then go do it again. And that's the math. And
there we go. Rinse and repeat. Now I have to give this another quick caveat. I have a student who's actually a coach now in my community as well. And he acquired a college. And when he came and told me about it, and he said it was distressed though. And I was like, well, why would you do that? I don't focus on distressed businesses. And he said, yeah, but he's a real estate expert. I'm not, right? So he was like, yeah, but at Beez, I wanted it because it had like, I forget how many acres of land and a solar farm on it. And I'm going to utilize the real estate for blah, 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 blah. And I was like, okay, well, I guess it makes sense. So I just want to say that caveat. I understand if you're a real estate expert and know how to get a distressed business because of the real estate to leverage it for taxes and other things.
Well, remember, I told you that, it's like I recognize my own weaknesses. I'm really good at business. I suck, at a lot of other forms of investing. If I'm going to invest in real estate, I know a lot of really good real estate investors. I'm just going to get money. I don't mind writing that check because you're an expert at that, And so I've got some clients that I work with who are just really good at what they do, and they're experts in real estate. I never will have their expertise in real estate, and so in that case, I'll just write a check. If I want diversification, I want a real estate investment, I'm going to give it to someone who knows what the hell they're doing. Because in today's market, there is a lot of opportunity. Where there is distress, there is opportunity. And the distress is in the financing and the way the capital structures. And some people paid too much for buildings and they're turning over the keys to the banks. And, people who've got the capital and the knowledge know how to pick the good ones. And they know how to make a lot of money with that. That's just not my wheelhouse. And so I would feed the capital to them. And so, you do bring up a point, though, and that is oftentimes, if we're an entrepreneur, we build a business and we also own the real estate. And I'll tell you that private equity doesn't want your real estate.
I've learned that too.
They don't. Yeah. So if you buy an asset like that, immediately create, a separate entity to hold the real estate, put a fair market lease in place with the operating company. Now you've got two assets. You build the company, and then when you sell it, the math doesn't change. You're still going to get those multiples, but the PE buyer doesn't want the real estate because the real estate's a different asset class, and it requires dual diligence. They got to tie up capital buying something that they're not supposed to be buying anyway because they're not a real estate fund. They're a buyout fund that's buying companies, and so it's like you need to separate all that stuff out, and then. If you put a fair market lease in place, you can be a landlord to the company even after you sell it, and as long as it's a reasonable rate and time. I've also had people who's like, well, I want a 20-year lease and I want it at, 3 times market value. I'm like, that's not happening. It's like, I'm not buying your company. You're going to rip that lease up and we're going to put in place, a 5-year lease at market rate, and I'll sign that deal. So
there you go.
Keep your real estate separate.
So listen, I have about 100 more questions, but I'm going to try to limit it to 2 or 3 max, just for sake of time. But I know you said that your daughter, I think, had homecoming, and my son has homecoming today, so I got to go to home to pick him up from the homecoming game and all of that too. But first question: what's your acquisition criteria? What are you looking for the most part? And I know you said the trucks and guys doing stuff things, but what business, any other aspect, industry, bottom line, top line, anything along those lines?
So I told you I always use that 30-20-10 lens, but that's a minimum. I'm really looking for I get excited when businesses are at about 20% net profit, 20% kind of EBITDA, free cash flow. I start to get more excited. So I'm looking at 20 to 30% net profit. That's a small company, 3 million. So the multiple's low, but they've got good free cash flow, good earnings. I don't mind buying that business all day long. Matter of fact, I want to buy 5 more of them, put them together and ring the bell. So for me, I do focus on services type businesses, recurrent revenue, contracted revenue, even better than just recurrent. And low capital expenditure, because I am going to do leverage buyouts. I need free cash. I want free cash. And so asset heavy companies don't work. They just don't work in an LBO kind of situation. If you'll pay less, multiple will be less, but ultimately when you're going to sell it, you'll have a harder problem. You won't get the same kind of multiple arbitrage. And so I'm focused. And so I think the biggest mistake entrepreneurs make is not knowing what good looks like. And so what I do, before I even get started is I'll create an investment thesis. I'll do some research on the industry. I'll try to kind of profile the need, the market. Is it growing? How big is the addressable market? How fragmented is it? Has to pass the phone book test. And the phone book test, and I know a lot of children out there don't know what the hell a phone book is. Never seen one. But we're old dudes. We got gray hairs up in here, so we know about phone books.
Well, for me,
So I'll go to 40 cities. If I took 40 phone books, opened the yellow pages, and I looked at pest control, and I see different names in each city. I might see a couple national brands in all of them, but I see different names. That's a highly fragmented market. I need a highly fragmented market. Why? Because for every 100 companies I look at, I might buy a couple, and I need a lot of them to look at. But aside from otherwise, it's like I'm going to set really high bars for what's good and what good looks like, and then I'm going to go out and look at a bunch of companies, and most of them aren't going to meet my criteria. And people who don't do this, they suffer from shiny penny syndrome. Shiny penny syndrome is I just want to do a deal so damn bad that I overlook the obvious warts. And I just bring it home and I make it work. And then after I buy it, it's like, oh my God, I'm in trouble. This sucks. This LBO stuff is a bunch of crap. No, if you have good filters, if you know what good looks like, and you think about that before you ever look at a company, and you keep, stick to your guns. I'm not only going to buy a good company, I'm going to buy a good company at a good price, at a low price. Fragmented market, there's too many of them. Not enough buyers to drive up the multiples. I'm going to get them cheap. And as I put them together, I'm going to climb the PE pyramid, and I'm going to get rewarded with multiple arbitrage. And that is going to lead to my success. So I'm always about, I'm going to do research on where I'm going to invest. Then I'm going to create, what are my filters? What does good look like? Once I identify what good looks like, I'm going to stick to my guns, and I'm a very disciplined buyer. And if a company just doesn't meet my criteria, throw it out, because it's fragmented market. I got another 100 I can go look at, and I'm going to be very disciplined on the buy side. And if you are, then your success, your odds of success are much, much higher.
So to elaborate a little bit more on what Adam said earlier as well, in terms of asset heavy deals are not good for LBOs. I have another student who is also a partner investor, and we were looking into the hotel industry, hospitality industry. And I quickly learned, no, I don't like this, because the hotel itself comes with real estate. That's the main aspect of the business. But the real estate is so much more than the cash flow available. And how are you going to service that debt to pay off if there's only a million in SDE? I won't even say EBITDA, because the smaller companies, there's only $1 million in SDE for it, seller discretionary earnings, but yet the deal costs $20 million because the real estate's worth $17 million.
Yeah.
Now you're in a bad position. So I quickly learned that as well when we looked at certain industries, and understanding what you're looking for and what constitutes a good deal is extremely important. As you get into this,
and the reason you got to be disciplined is this. Look, in baseball, the player with the highest batting average ever was Ty Cobb, and I think his career batting average was 344. He had some years over 400, but I think 344. And so maybe I'm wrong. Who knows? Ted Williams. But last time I googled it, it was Ty Cobb, which means that 6.5 times out of every 10 at bats, or 5.5 times, 6.5 times, this guy's getting out. Yeah. If you're going to do an LBO and you're going to buy and build and put 4 or 5 companies together, you got to bat about 990 or higher. You cannot, on 20 companies, I can get one wrong. If you get 4 or 5 wrong out of 10, you're out of business. It's like you're done with LBOs, and you realize that's not my wheelhouse. So you got to be very, very disciplined on the buy side and be patient.
Definitely. So Adam, I have a proposal for you.
Okay.
I'm going to provide the deals and the roll up, do all the legwork, have my team running everything for you, give you equity just for you to help to consult and continue to help us to get to the 9-figure or higher.
That's my life today. That's what happens. And, when someone calls me and says, or reaches out to me on social media, and the first word out of their mouth is, I got a great idea and I'm looking for money. I'm like, you don't understand my value. You don't understand my value. My value is not my wallet. My value is what I've learned, across 35 years of business and 21 doing buy and builds, and making institutional shareholders billions. that's my value. And so that's the kind of deals that I'm getting now. And now that I'm out of the CEO seat, it's like they're just, falling out of the sky. It's like, Adam, just put your brain to work. I'll give you X% of the company and help me navigate this, keep me out of trouble, and help me get to that finish line, and there's a payday in there for you. And so that's what I'm doing. That's it's been a lot of fun, and it was because I had left the CEO seat that those opportunities started to materialize. And I had to ignore them before. And the other thing I get all the time is hey, Adam, I'll give you some founders equity. It's like, brother, I can't buy time. Time's the one thing I cannot buy. And so everything I do has to be compensated. And, this is how I earn a living. So it's like, getting founders equity, that's for the retired guy who just wants to, get on a call once a month and feel like he's, adding some value. It's like, I still got game. I'm playing the game every day. Founders equity doesn't work for me. And it's not that I don't appreciate people doing startups. It's like, it's not my bag. I'm a buyout guy. I do buyouts. I do M&A deals and roll-ups. I mean, that's my area that I'm focused on.
There you go. I love it. I'm
down for that. Let's do that.
Okay, I already listen. I told you we're already in a few areas for roll-ups that we're focusing on right now.
Hey, Ty Cobb 366 is the highest.
Look, they got it.
I might have said 361, but I knew it was 360 something because there was a controversy. I said this at a seminar recently, and someone said, "No, it's Ted Williams." And I don't know about that. And so everyone was Googling, and it's like, it's like, good, Ty Cobb. Okay, all right.
All right. Well, Adam, this has been awesome. So I want to leave the audience with my segment that I told you about. It's called Pop. Right. Yep. So we're gonna pop the private equity industry and how become a billionaire through private equity. And Pop is all about what are the pros related to private equity? What are the opportunities that exist or are coming up? Why we should be looking into private equity right now? And most importantly, what are the problems or challenges that we should be aware of with private equity?
Yeah. Well, so first of all, the pros, private equity is the world's largest non-bank lender. And a lot of people don't know that. It's the world's largest source of capital that's not, from a bank, and so there's buyout funds. There's also debt funds. There's people, there's funds that do nothing but loan money to other PE firms or to entrepreneurs. And so, the pros are, if I'm working with private equity, my checkbook goes away. I'm now using their checkbook, other people's money, banks, really what they bring to the table. Once they buy a company, they put their checkbook away. They bring relationships with debt providers. And when I do a buy and build or a roll up, I'm using third-party debt. And because of their size and their relationships, I can get outsized chunks of debt for a company at a given size. And I can really, just go gung ho on buying and building. And that's what leads me to do 23 companies or 34 companies in a buy and build, is because I've got unlimited capital. So that's a pro. An opportunity is I get to, if I understand how private equity works and I feed it what it needs, which is returns for its limited partners, I can get what I want, which is wealth creation for me and for my family. And I can build a cool company that takes care of employees along the way. Now let's talk about the problems. So I did write a recent article for Forbes. 73% of all entrepreneurs who sell to private equity do not survive the first 5-year hold period. 73%. Only 27% of founders that sell and go on to work with private equity survive. Why is that? Well, a portion of them were old and wanted to retire. A portion of them just got this wheelbarrow full of gold and they start to check out. And your partner's like, dude, I may have given you a pot of gold, but I haven't gotten my gold yet. You better get your ass back to work building this company because I'm backing you, and then you do have some companies that just go astray or it's like, hey, the model was wrong, economic times shifted or something unforeseen happened. But the problems can be, and I used to tell people, I have a love-hate relationship with private equity. I love paydays. Brother, I'll be honest with you. It's like, I love paydays. I sell a company, and it's like, and then I go to my bank account, I'm hitting enter, boom. Yeah. Oh, baby, like, yes, that was a good one. But it is a professional sport. Make no mistake that PE operates at a very high intense level. And, and you got to be ready for that as an entrepreneur. And so the love-hate part, the hate is, Kobe Bryant, he's a bad example. But most professional athletes don't like practice. They don't like going, I got to go to spring training, and do mindless shit for 3 months before the real games start and they count. And, the reality is that when private equity is buying your company and you're partnering with them, it is business as a professional sport practice at the highest level. And they have really high expectations, and rightfully so. And because you're aligned, you may be a rollover investor now, and they've granted equity in other cases, you're going to get paid too. You're going to get, they share the wealth when the wealth gets created. Yeah. When the wealth doesn't get created, you're going to get help, and you don't want help. Trust me. And so, your life can be miserable in the grind, of the 13 game, 13 city road trip in the middle of summer and the dog days of summer. It's like, and you're like, wow, this is a long season. And so there's a lot of intensity. And the problem can be, it's hard to survive, at times. If you're not playing at 110% all the time, you could have problems. But, and when it works well, and the wealth is shared, and the wealth creation is a beautiful thing. And so, that, I think for me, that's the pros, the opportunities, and the problems. Pros, unlimited capital. Opportunities, I can create wealth. Problems, it's hard. It's tough, and at times, if there's issues, it's like, hey, you're going to get traded. You're going to, it's like, I'm going to bring in another pitcher because this pitcher ain't getting the job done. Yeah. And that's the life of a PE-backed CEO. It's the hardest thing for me to ever have done is to get out of a company. Yeah. Because when you do well, the next guy wants you to stay, puts handcuffs on you to try to keep you there. And it's like 13 years later, it's like, there must be life after laundry, it's like,
So I love that you helped us to actually pop the private equity industry. Now we know more about it. You actually helped me to frame my approach to private equity, because if you always remember what they're looking for, then you can offer value based on what they need. And that's how
and you really need to understand the game. Little nuances. Like, I could give you an example. Let's say a brand new fund buys my company in their first year. Mm-hmm. And so if I can do a good job and get a lot of buy and build done early, and I can get them to their 3x multiple or 4x multiple in the first 3 years, they're going to sell me early. Because they're going to put a headline high IRR, which is their rate of return, their investment rate of return, their internal rate of return, however the hell you want to define IRR. But it's the percent of return. They're going to hurry up, sell that company quick, and they're going to use that as the headline price. Look, this current fund's already got one asset sold at a 54% IRR. I'm raising my next fund. Give me a bunch of money, Mr. Limited Partner. Well, what's great about that? Well, what's great about that is, what's better than selling your company? The typical PE hold period is 5 years. It takes about 5 years for them to run a cycle between buy, improve, build, sell. Well, if I can do it in 3 years, let's say I got a 21-year career. If I can sell a company on average every 3 years instead of every 5, then I'm going to get 7 paydays instead of 4. Right?
It's just awesome. Exactly.
So many nuances that we could talk about all day.
Definitely. So Adam, listen, I know this is just so much fun. This was an amazing conversation. Very educational conversation. I actually learned some stuff as well. The audience, I'm sure, I saw some of the comments going by, and I know that everyone really enjoyed it. I'm going to give a quick last question and answer to one of the questions I saw pop up last. Rhonda Hines, and she mentioned, she's actually part of my community as well. And she asked, what are your thoughts on franchises? Now, I know she's asking that because she knows I don't like franchises, except for if I'm going to get the whole thing. not the franchisee from one. I want the franchisor that has all of them. I get it from the top. What are your thoughts on franchises?
Yeah, I don't like them either. We're on the same page there. I don't like them either. Life is short. I've got a limited amount of time. I'd rather focus on companies that I can buy that are independently owned, and I can amalgamate them and put them together and climb the pyramid and sell them. When I get into a franchise type environment, it's like, yes, I know the PE's involved. It's like, but franchisees and franchisors, boy, the rules can change. It's like you got a limited market when it's time to sell. So if I can't get the whole universe of buyers to play, I have some risk that's going to be created on exit. So I'm not telling nobody should ever do a franchise. I'm just saying it's not going to be me.
Exactly. There we go. All right. Well, listen, Adam, thank you so much for an amazing conversation, for your insight, for your for being candid, again, for your service as well. It's just amazing. I want more people to know about you. I'm like a fangirl because I'm in the industry and I know you, but other people, need to know more about what you've done. And I hope this platform helps to get the word out more. So
I hope it does too. And I'll tell you what, Tuesday, October 24th, and this will be available. Empire Builder, help me out. And let's make this my third #1 bestseller.
Let's go. Is there how should people contact you? Get in touch with you?
LinkedIn is the easiest. Look at my name, Adam Coffey, Coffey. You'll find me on LinkedIn. I'm very responsive to people on LinkedIn. That's the easiest way to get a hold of me. Awesome. You can go to adamecoffey.com as well. That's my website, but LinkedIn is just efficient. I'm on there multiple times a day. I'm always, on there, and I respond. Sometimes it takes me a while, but I respond.
One last thing, as Steve Jobs would say, and one more thing. What is Coffey Aviation about?
That's me flying a World War II P-51 Mustang on that bottom picture, and I'm doing an aileron roll over. That was actually over in Southern California in Orange County. I'm holding a GoPro in one hand as I'm going around like this. And so I enjoy being a pilot. If I rotate that up, that's my little fair weather burger chaser up there. And that's me around Catalina Island. And so it's I'm a pilot. Enjoy flying. I sit in the back of jets now instead of one. As I get older, and my wife and my kids, like, hey, it's like I'll ride in the back. I don't need to be up front anymore, but I still love a good adventure. And so I that's what that was about. There's a bunch of videos of me doing all kinds of crazy stuff in airplanes. It's one of my passions. So I'll close with: there's 4 sins a man can have, and I'm leaving women out of this. Boats, planes, RVs, right? And cars. And I'm guilty of 2 of them, cars and planes. So I love boats and RVs, but I stay away from them because I'm already guilty of 2 of the 4 sins. And so, yeah.
Okay, so when we hang up, stay on so we can speak backstage, because I got something for you that you're going to love.
Okay, all right.
Well, thank you, Adam. Everybody, you already know what to do. Make sure that you like and subscribe if you're watching this on YouTube. Make sure that you're tuned in to every podcast platform so you don't miss conversations like this with Adam Coffey. Let's go. Thank you so much. We'll see you on the next episode.